A few years ago, it was hard to imagine a situation where China would not surpass the United States and become the world's largest economy in the near future. Now, it is clear that this significant geopolitical event is almost certainly being postponed, and one can even envision scenarios where it may not happen at all. Chinese people are not spending money, businesses are not growing, and conflicts with the West are deterring foreign investors and trading partners. The previous growth recipes are no longer effective, and the range of new ones is severely limited. This is bad news for both the authoritarian Xi Jinping and the Chinese people, accustomed to improving their living standards each year, as well as for the entire world, which is dependent on the Chinese economy, the second largest after the USA. So let's delve into why China won't become a superpower in the near future. Before we start, please support my channel by clicking like and subscribe buttons. To begin with, let's consider a list of dry facts. The Chinese economy is slowing down. Fitch Ratings expects a decelerated trajectory of 4.8% in 2024 and 4.7% in 2025. For comparison, China's GDP grew by 8.45% in 2021. Debt is increasing. China's debt reached a record level at the end of 2022, surpassing the GDP threefold, $51.87 trillion, or 295% of GDP. According to the International Monetary Fund, the total debt of Chinese LGFVs, local debts, rose to a record $9.2 trillion, equivalent to half of the country's economy. Export is declining. Exports to the United States, one of China's largest buyers, fell by 23.1% in annual calculation. The European Union also purchased 20.6% less from China. Freedom is diminishing. China is increasing supervision over banking activities and technologies. Deflation has begun in China. Wholesale prices, which businesses usually pay to factories and other producers, have been decreasing for 10 consecutive months compared to the previous year. Property prices are also falling. The Chinese government is pressuring economists within the country not to mention the possibility of deflation, publicly denying that deflation is a risk. A real estate market crisis has started in China. China Evergrande, another major property developer, has already filed for bankruptcy in the United States due to the restructuring of its $300 billion debt. Zhongrong International Trust, managing assets of about $85 billion, also declared default. Another developer, Country Garden, faced default after missing payments to creditors and having unpaid bills totaling $200 billion. According to Standard & Poor's, more than 50 developers in China have failed to make payments in the last 3 years. Real interest rates and the cost of financing, faced by most Chinese companies and home buyers, are rising. Household debt in China is creeping up. According to a report from the National Institute of Finance and Development published in the second quarter, household debt in the country reached 63.5% of the national GDP, approaching the critical zone of 65%. The growth rates of industrial production and retail sales are decreasing. Industrial production increased by 3.7% in July 2023 compared to the previous year, lower than the expected analyst growth of 4.4%, while retail sales also grew at a slower pace, 2.5% at the end of 2023. Investments in China are rapidly shrinking. Foreign direct investment in China has fallen by more than 50%. China's strict zero-COVID policy, which blocked the commercial center of Shanghai for much of 2022, has increased external uncertainty and contributed to the loss of investment momentum. China, in an attempt to replace the IMF for developing countries and strengthen its influence on them, has already spent almost $1 trillion on their financing. Unemployment is rising in China. According to the National Bureau of Statistics of China, the unemployment rate among Chinese aged 16 to 24 reached a record level of 21.3% in June 2023. For comparison, the unemployment rate among people aged 25 to 59 is 4.1%. As a result, there is a reduction in consumer spending in China and additional losses to the economy. The process of shifting production from China to other countries is accelerating. Recent examples include Intel has shifted chip production from China to the United States, Taiwan, and Mexico. Tesla has moved the production of electric vehicles from China to the United States and Germany. IKEA has relocated furniture production from China to Vietnam, Indonesia, and Poland. Walmart has transferred the production of consumer goods from China to Mexico, India, and Indonesia. Procter & Gamble has shifted the production of household chemicals from China to the United States, Mexico, and Brazil. Over the past 4 decades, the size of the Chinese economy has multiplied several times. The idea that such growth rates can be sustained indefinitely contradicts fundamental economic principles. Sooner or later, certain cyclical patterns which force weaker players to exit the market will inevitably make themselves known. At one point, a simple shortage of qualified labor will put an end to the constant ascent. Growth has structural limits, and China is already close to them. Similar scenarios have occurred in Asia before. In the 1980s, when Japan was the most dynamically developing economy in the world, common sense suggested that it would surpass the US with its economic power. However, when the surge sharply slowed down, a total banking collapse occurred, from the consequences of which the country never fully recovered even after 30 years. Here are the main factors influencing the Chinese economic issues discussed at the beginning of the video. Lack of trust. Chinese people do not believe that life is improving. The lockdown in China was much longer and harsher than in the rest of the world. Its scars run deeper and heal slower. Incomes are not growing as they did before the pandemic. People fear the future and distrust the authorities, leading them to save money rather than spend it. Business uncertainty. The business environment is similar. The wounds from the pre-COVID crackdown on billionaires have not healed, and companies are hesitant to invest in expansion. Conflict with the West. China's prosperity relied on globalization as the junior trading partner of the West, growing into the world's second-largest economy. However, the symbiosis has turned into a competition for world leadership, and the West has engaged in a trade and technological war with China. The outcome of this ongoing separation remains unclear. Decreasing Western investments. The conflict is deterring foreign companies, leading them to seek new locations for production expansion in countries like India, Vietnam, Egypt, Turkey, and Mexico. Exhaustion of growth sources. The previous sources of growth are nearly depleted. The catch-up growth driven by urbanization and industrialization is complete, and the rapid increase in the working-age population is a thing of the past. Structural imbalances in the Chinese economy are proving difficult to correct. Authoritarianism impact. Experts attribute the economic challenges to Xi Jinping's authoritarianism. In the first decade of his rule, market reforms halted, and the role of the state in the economy strengthened. Experts doubt that Xi is ready for a true shift from consolidating power and strengthening the party's role to greater economic and societal freedom. Russia's war against Ukraine. Russia's war exacerbates China's conflict with the West. The deficit in foreign investments and the reduction in exports to a crisis hit Europe. European nations, alarmed by Russia's gas war against the EU, are eager to diversify their strategic suppliers, moving away from dependence on China. All these problems have led to the main engines of economic growth, exports, private investments, and consumption stalling. Without market and political reforms, the government might stimulate the economy with state investments and subsidies, as done in previous episodes of Slowed Growth. Economists and businesses collectively urge Chinese authorities to take this step, acknowledging that without government support, the economy won't revive. However, stimulating the economy through borrowing becomes increasingly challenging. The debts of central and regional authorities are approaching 100% of GDP, an unusual level for countries with a development status similar to China's. Moreover, previous rounds of government support resulted in bubbles in industry and housing construction. Now, the government aims to stimulate consumption rather than production to modernize the economy. Yet, the traditional method of lowering central bank rates does not lead to increased consumption because Chinese people are accustomed to minimal returns on deposits. They save not for profit, but out of fear that they won't have enough for old age, illness, and their children's education in the future, with little assistance expected from the state. China finds itself in a vicious circle, where with each new round of government support, costs increase, and the effect diminishes, as described by Kat Kijin, professor at the London School of Economics. One must be prepared for China to grow more slowly in the future because it is currently going through a transitional period from industrialization to an innovative economy, she said in an interview with Bloomberg. China's main reserves lie in demographic breakthroughs through government policies aimed at increasing birth rates and technological breakthroughs through massive investments in automation and artificial intelligence. Achievements in these areas will enable China to alleviate some internal constraints on the path to rapid growth. However, this is only half of the equation. To address the external causes of the current crisis, Xi Jinping and his ministers will have to find common ground with the West. Yet, serious progress in this direction is not yet apparent. That's it for today. Thanks for your time. Please do not forget to support my channel by clicking like and subscribe buttons.